Thank you very much, Chris, and hello, everybody. It's a pleasure to be here with you today talking about VAT, and I've got some updates on customs duty and some other taxes for you as well. In short, I'm going to cover an update on the autumn budget changes and what's been happening about those since, an update on e-invoicing, what you need to know and what you need to be doing, current consultations that you might want to put have your opinion heard and how you can do that. News from HMRC about what they're doing, the usual story of how well they're doing when obviously people like us who work with VAT know that it's not going quite so well, but I'll cover that. Then I've got something wonderful, which is a case. I'm laughing because, you know, us VAT people, we love cases about food and zero rating or standard rating. So I've got a case on biscuits, which is really exciting. Then I'm going to talk about President Trump and customs duties on goods going into the US. I'm going to tell you about a new service to get hold of data about your own customs imports into the UK. And finally, I'm going to talk about something called CBAM, Carbon Border Adjustment Mechanism. So hopefully all of this will become clear as I go through. Firstly, then, the budget changes. Gifts of goods to charities to be zero rated from 1 April 2026. So the idea behind this is that it will reduce costs for businesses who are donating to charities and therefore encourage more donations of surplus stock. That's the plan. Currently, donations of goods for sale or export by a charity are for sale or export by a charity is zero rated. But if you donate goods to a charity for them to use or to give away for free, then the business usually has to account for output VAT on those goods if they originally recovered the input VAT. So what's going to change? Well, from 1 April, businesses won't have to pay VAT on goods that are donated for direct use in the charity's own services. And also on goods donated for distribution to beneficiaries. So, for example, food banks or shelters. Conditions are that goods have to be donated by a VAT registered business. And generally, they must be intended for sale, hire or direct use in charitable activities. So that is from 1 April. If you've got something that you're thinking of donating, I suggest you wait until then. So that there's no VAT charge on that donation. Next, changes to application of TOMs. So I am a TOMs specialist. I do a lot of work with the travel sector, and normally it's this tiny little weeny bit of VAT that no one knows about, but it's come into its own in the last 6 months or so with a number of cases and with a change in the budget. So the scheme requires VAT to be paid on the margin and not the selling price where you buy in and sell on certain travel supplies like accommodation and transport services. Now, HMRC was somewhat upset because Uber and Bolt had positioned themselves to be able to buy in the services of taxi drivers and supply them on to customers, claiming that TOMs applied and they only had to pay VAT on the margin, the difference between the buying in price and the selling on price, and not the full fare. So HMRC have been taking cases through the courts against both Uber and Bolt, and currently Bolt is winning the argument, Uber appearing again shortly in the courts. So the government decided to change the law, and therefore from the 2nd of January 2026, TOMs cannot be used for the supply of taxi journeys. So what that means is that for Bolt and Uber, who are buying in and selling on taxi journeys, they cannot use TOMs. They have to apply normal rules, so VAT is due on the full selling price. There is an exception for normal tour operators, try and make sure that I say normal, but you know, the likes of TUI and so on, those sorts of tour operators are not impacted by this. And that is that if a taxi is supplied in connection with accommodation or another type of passenger transport, then TOMs can still be used. Now, because we're no longer part of the EU, it means the government can make these changes as they please, and there's not a lot that can be done about it. When we were part of the EU, it wouldn't have been allowed. No changes like this could have been made. We do know from our clients that actually, even though there's this exception for normal tour operators, it is still impacting some tour operators. For example, a business that perhaps buys in a taxi and driver and supplies it with a guide. I don't know if you've seen, like in London, you can have a taxi tour of London, that sort of situation. This would normally fall under TOMS, or it would have done, but now the guide would be within TOMS and the taxi would be normal rules, which gives real problems for VAT accounting because it's different tax point dates for TOMS supplies and also for pricing. So we're following this closely. If you're involved in that sort of area, you need to be aware of this. It's in now from the 2nd of January 2026. Next up is the chance for a claim. We love a chance for a claim, don't we? HMRC announced they changed their view, and it came out of the blue actually, where a UK taxpayer is VAT grouped with an overseas establishment. Previously, HMRC said that services provided by the non-UK establishment to the UK one had to be reverse charged, meaning VAT had to be paid on those services, and that VAT would then be recoverable as long as those services were used to make taxable supplies in the UK. What this meant was that banks and financial institutions couldn't recover all of that VAT and therefore suffered a loss. But now HMRC have reversed their previous position and they accept that there is no reverse charge VAT due where you've got services being provided by an overseas establishment to UK establishment, and that those entities are within a UK VAT group. So HMRC are inviting claims for VAT overpaid by partially exempt businesses in the last 4 years. If you're affected by that, work quickly, get your claim in. Obviously, the 4 years is a moving feast, so you want to be quick on that one. Next up, a proposed zero rating, which would apply to the sale of land intended for social housing, and a consultation that is going to begin soon. Currently, a sale of such land intended for use by a social housing provider would be exempt unless there's been an option to tax. Housing associations can sometimes avoid the VAT charge by issuing a certificate to disapply the option to tax, but that's not great for the vendor, who may then suffer a clawback of VAT that they previously recovered on the purchase of that land. So what we've seen in the past is so-called golden brick schemes that have been used to allow zero rating when a building is under construction. So what happens is the construction is started, and once it reaches golden brick stage, which is foundations or floor laid, then the sale would take place and would be a zero rated sale because there is a building to be sold. So now the idea is that this new zero rating would need to wait for golden brick stage, and it could speed up transactions, thus speeding up the provision of social housing. That's the idea of that. A new advanced tax certainty service is to be introduced in July this year for large projects of £1 billion or more. It will cover corporation tax, VAT, stamp duties, PAYE and the construction industry scheme, meaning that HMRC is bound by the clearance for up to 5 years, as long as you disclose fully all material facts. So I think that's a good step forward there for some certainty for these huge projects. Where's the change to the capital goods scheme? Well, this is an interesting one. We were expecting legislation and an announcement in the budget updating the capital goods scheme. So this is a scheme that makes VAT on some capital assets subject to adjustment over 5 years or 10 years. Assets are currently large property purchases, construction, refurbishment, renovations. There are also computers, ships, aircraft and boats when you buy those. Currently the threshold is £250,000 exclusive of VAT for property, 50,000 for computers, and ships, aircraft and boats. So the change we were expecting was for the 250k for property to be increased to 600k net of VAT, which sounds like a lot, but actually because that 250k hasn't changed at all over the years, it actually just puts us back in the situation that really we should have been if there had been increases as the years went by. So 600k, anything that you are still within the capital goods scheme for and still adjusting, you'll have to continue adjusting, but you will no longer have to put new computers in the capital goods scheme. But the 50k threshold remains for ships, aircrafts and boats. So the legislation isn't in the Finance Act, but the rumour is that it will still come through, that at some point there will be an announcement and that the changes will apply to VAT periods ending on or after the 31st of March 2026. Moving on to e-invoicing. The budget announced mandatory e-invoicing in the UK with effect from 2029. And I just want to cover in a little bit more detail what this means and what you need to be thinking of in your own businesses now. So what is e-invoicing, first of all? It's the digital exchange of invoice data directly between buyers and suppliers' financial systems. So it's not a manual situation at all. It's all done digitally. And the process enables an invoice to be sent and received digitally, automatically integrating it into the buyer's system, reducing the need for manual processing and improving efficiency. That's the idea. From the government's point of view, it should reduce the VAT gap, reduce errors, and that's their plan. It's also being introduced around Europe. There are a number of countries so far that have introduced it. So this is the UK kind of coming into line with other countries within the EU. It's only going to apply to VAT invoices, so mandatorily. So that means B2B and business to government transactions. So for example, if you're a retailer and you're invoicing or giving a receipt, you won't have to use e-invoicing. It's likely there's going to be a decentralized e-invoicing model. So what that means is businesses exchange e-invoices directly through software providers, rather than there being a centralized model, which is where e-invoices would be submitted to a centralized government platform for validation before being forwarded to the buyer. So that's not what's envisaged, but I'm only telling you where we are now, and obviously there's a good few years until it will come in for sure, so things might change. The hope is the UK system will be aligned with international frameworks, such as the Pan-European Public Procurement Online, or PEPL for short. That's a framework allowing system compatibility across borders and platforms. So businesses will need to be ready. You'll have to have your tax staff, your IT staff and your finance staff all involved in the preparation. You'll need your software providers to be ready. If you've got bespoke software, then obviously you'll need your own IT people to be on the ball, getting ready for this, so that you can be sure that you are complying with effect from 2029. And I would suggest that you start working on it now and perhaps introducing it early. E-invoicing is being introduced in EU countries this year. Belgium, Poland, France and Greece are introducing it. So some of you may already be having to get to grips with this. The government has also said that it will continue to look into requiring real-time reporting of transactions to HMRC. So this is where you would have to supply information at the same time as you issue your invoice to HMRC. So that's the reason why HMRC would be hoping that the tax gap would be reduced, because they're getting information in real time. They can raise queries in real time. So they've said that they are going to do that, but they're not going to do it at the same time as introducing e-invoicing. few, because that really would have been something, wouldn't it, if you were having to deal with all of that at the same time. Moving on to the next slide, covering consultations. So the first one here is something that will affect all of us. The government has announced that they're going to allow local authorities to introduce visitor levies. It's going to start in Edinburgh this year. It's already operating in Manchester, and you have an opportunity to feed into that consultation. In particular, I think the issues are kind of whether VAT is payable on the levy, or whether the levy is charged on a net amount and VAT just added to the net amount. That's what's happening in Manchester. Usually it would apply to all kinds of accommodation. So I'm talking hotels, hostels, guest houses, B&Bs, self-catering, short-term lets, campsites, Airbnb, you name it, it will probably be covered, but you can have your say about that in the consultation. And I suggest that you do make your voice known, especially if you are in the accommodation sector, because you will be the ones that will have to collect this money and pass it on. So it's going to be a real burden, because, for example, if Edinburgh have it at 5% of the accommodation price, which is what they're saying, and then London has it at 2%, your software will have to deal with issuing the right amount of the levy, collecting the right amount. So something to be thinking about. Next up, there is a consultation now about this new electric vehicle excise duty, or EVED. It's going to proposed to apply to electric and plug-in hybrid cars and be based on mileage that these cars will do. So, for example, 3p per mile for electric vehicles, which is about half what a petrol or diesel driver would pay in fuel duties, according to the government. I'm just telling you what they said. And 1.5p, half that per mile for hybrid vehicles. So that is going to end on the 18th of March. Sorry, the visitor levies one will end quite soon, on the 18th of February, if you wanted to put a comment in on that. 18th of March for the EVED. Another consultation is the removal of the £135 customs duty relief for low-value imports of up to £135 from March 2029 at the latest. So HMRC is hoping to bring that in prior to March 2029. So if you bring in low-value items, you have to account for import VAT at the moment, but you get a relief from customs duty. The proposal is to remove that relief. So if you're impacted by that, I suggest you comment on the consultation. In other news, and this is from HMRC, please don't shoot the messenger here. I'm telling you what they have told us. HMRC is considering what supplementary data they might require businesses to report in addition to VAT returns. So this is in addition as well to real-time reporting and e-invoicing requirements, that there might be further supplementary data that may be required. Now, I think this is really scary, because this could be an enormous burden for businesses. So I'm watching this closely. HMRC intends to digitalise more correspondence. Some of you may know they still use the postal system an awful lot, particularly sending items by post to overseas businesses, which of course don't get there in time for businesses to respond. So surely this can only be a good thing, fingers crossed. They say that they are within their agreements for service performance, these SLAs that I mentioned here, for everything. I don't think so, but that's what they say, except for new VAT group applications, which are currently taking 55 working days, which is what, 11 weeks. I think it's taking longer than that. So be aware that these things are taking some time. Actually, I think HMRC only have to say that they've got 80% of everything within their SLA to be able to say that they're achieving the SLA. So maybe they are within the 80%. Finally, on this slide, just if you're a solicitor and you hold client money in client accounts earning interest, HMRC are attacking this and saying that that interest cannot be ignored, must be included in partial exemption calculations, even if you give the interest to your client and don't retain it yourselves. So just something to be aware of there if you are within that sector. Now, you are going to love this. I have got some VAT cases for you. So first of all, Hotel Latour. Oh, it's divided the VAT world. We've had some consultants saying, well, of course, Hotel Latour should have lost. Another one saying, no, they should have won. So it's really been an interesting case, this one. It was about whether you can recover VAT on professional costs relating to an exempt share sale because, or on the basis that the proceeds of your share sale were going to be invested in a new hotel that would make taxable supplies. So it's kind of about whether you could look through and ignore the VAT liability of initial supply and allow VAT recovery to depend on subsequent use of those funds. Hotel Latour won at the first tier tribunal and the upper tribunal, but they lost at the Court of Appeal. And I'm afraid that the Supreme Court has agreed with HMRC that professional fees incurred in this case were directly and immediately linked to the exempt share sale, not to the wider taxable business, so no input VAT recovery. Quite an important case, that one, for recovering VAT on costs of transactions. Next up, again, we're back to Tom's. This time I'm talking about rent-to-rent businesses and the Sonder case, businesses that rent in accommodation for a year or more and then rent it out for a night or two or more. There are a lot of businesses that do that, usually on Airbnb or Booking.com. Rent-to-rent businesses said, well, we should use Tom's for this and only pay VAT on the margin, not the selling price. HMRC disagree. Sonder won their case at the first tier tribunal but lost at the upper tribunal. And we were waiting for the Court of Appeal case to be heard later this month, actually, but Sonder has gone into liquidation. The case may continue. It's currently been postponed, but it may continue if enough funds can be found from interested parties to continue the appeal, which I kind of hope it will be, so that we get to hear the full story. I mentioned Bolt earlier. HMRC have been granted permission to appeal this at the Court of Appeal. As said, this is about buying in and selling on taxi journeys. Now, this is a real treat. Biscuits. And what is the VAT liability of biscuits? So I've got two packets of biscuits here, which are the ones that I want to talk about. Ferrero UK Limited make Nutella biscuits on the right-hand side, there, the picture. United Biscuits make Blissfuls on the left-hand side. And you might think to yourself, well, they look quite similar, really, don't they? And they kind of are, as I understand it. They both have like a nutty chocolatey inside, and they've got pastry as a little tart with a lid on them. Do you think they look much the same? I think they do. The difference perhaps being that there's like a bit of a lattice top to the Blissfuls, and the Nutella biscuits don't have that. They have more of a solid top, but you can see the chocolate peeking out the side, can't you, from those Nutella biscuits, whereas you can kind of see it through the lattice top and at the side in the Blissfuls. So the VAT tribunal previously decided that the Blissfuls were standard rated, but then they decided that the Nutella biscuits are 0 rated. Now, the VAT law says that if a biscuit is wholly or partly covered in chocolate or a similar product, then it must be standard rated and not 0 rated. And what the tribunal in the Blissfuls case decided was that there is a chocolate covering on part of the biscuit, because of this lattice effect, but they decided that there isn't a chocolate covering on the Nutella biscuit. I don't know. I'd love to know what you think. I should have done a poll so that you could put your opinion forward. My opinion is the Biscuits, they're not covered in chocolate. It's just you can see it through. I mean, I'm thinking of, a McVitie's chocolate biscuit which has a covering of chocolate on it. That would be standard rated. In my head, both those two should be 0 rated. Anyway, look, I'll leave that with you, and also with the knowledge that I absolutely adore the Nutella ones. It'll give you something to talk about in the office. I can just envisage you all having discussions at home and in the office about what's 0 rated and what's standard rated and which of those two biscuits is best. Before I move on from cases, I can see there's a question about the Isle of Wight NHS Trust case on the chat, so I'm going to talk about that briefly. The tribunal ruled that the supply of locum doctors is an exempt supply. Now, up to now, HMRC have held that it's standard rated and that VAT had to be charged where locum doctors were supplied, even though there has always been an exemption in the VAT law. So finally, despite a number of cases, HMRC have now said, well, we're not appealing this case. They accept the decision, so the supply of locum doctors is exempt from VAT, and they are saying that locum doctor suppliers can put in a claim for the VAT that they've declared. They would also have to consider whether there is any input VAT that needs to be repaid under partial exemption as well. If you are a customer of a supplier of locum doctors, then you'd want to be talking to your supplier to say, well, look, hello, please can you make a claim and pass that VAT to me because we weren't able to recover it in the first place. Quite a complicated situation this is, but something for you to think about if you are within the healthcare sector or if you are supplying locum doctors. Finally, on customs duty, I'll go through these quite quickly so I can see time is moving on. President Trump, then, he's under challenge in the US Supreme Court because, as you probably all know, he increased customs duties significantly on some products from some countries, and certain businesses have put in a claim which has gone to the US Supreme Court. So that was heard last year. We're waiting for the Supreme Court to give its opinion as to whether the duties have been illegally applied. If they have, then the US government will have to repay those increased duties to importers of goods into the US. So there's a possibility of a refund claim. Mr. Trump, in his characteristically understated way, has warned that the US could face massive economic consequences, he says, if the Supreme Court rules against him. But you know what? If he does lose, for sure, he'll find another way, won't he, of increasing duties by some other means. So watch this space. If you have paid those massive duties, start thinking about the possibility of making a claim. And talking to suppliers and so on. Moving on, so TREE or TRAY for short, I'm not sure which it is, Trade Reporting and Extracting Service. This is a new service for UK and Northern Ireland importers, expected to be in place by March this year. It will enable you to get easier access to your customs data, free of charge, no need to pay. It should help you with customs compliance, but be aware that the data is very complex and the rules around getting it, as you can see there, are quite complex too. I do wonder whether having that data available could encourage HMRC to apply penalties if businesses don't tighten up their customs compliance. So just bear that in mind. And finally, CBAM. So this is a Customs Border Adjustment Mechanism, or CBAM for short. The EU introduced a similar CBAM in January last month. For the UK, we're expecting this new tax to be introduced in 2027, so that's next year. And what it means is that importers of these goods, aluminium, cement, fertilizers, hydrogen, iron, and steel, into the UK will have to pay effectively a tax, they call it a carbon price, on imports of these goods to make sure that non-EU producers face similar carbon costs as EU producers do. So it's to try and even things up. But what that means is that if you do import 50k or more of these products in a year, you have to register and pay the tax. And this first year that you need to do so is the year ending 31 December 27, and that needs to be paid by 31st of May 2028. Just yesterday, HMRC published a policy summary document and draft statutory instruments, so things are moving. I do recommend if you that you review your imports, see if you're going to be in scope, review supply chains, emissions, contracts, and so on. It's a really complicated thing, this CBAM. So it would be good to try and focus on that. So that brings me to the end of this session on VAT and indirect taxes. I hope you found it interesting, useful, enjoyable. Maybe you're going to go and help yourself to one of those lovely biscuits, Nutella biscuits. And I'm going to hand back to you now, Chris. Thank you.
Thanks, Sue. Lots of insights there, lots covered in a short space of time, so really appreciate that. We really should have done a poll about Blissfuls versus Nutella biscuits, but didn't get around to it this time, unfortunately.